Good afternoon to our CLA family members, clients, community partners, and friends. Welcome back to our 8th live stream. We're grateful to have all of you, and we truly wish you, your families, and friends health and safety during this time. I want to start today with a couple quick housekeeping items before we dive into our topic. First of all, we really want all of you to ask questions during the session and be part of the dialogue with us. And there's lots of ways that you can engage. First, during the session, remember that we have subject matter experts available to chat and respond to your questions, and we'll try to address these as best we can as well during the presentation. Also, at the end of the session, to the extent your questions aren't answered or something else comes up, feel free to contact your CLA advisor, or you can follow up with us using the dialog box at the bottom of the page. And you can also reach out via our COVID-19 Resource Center at www.claconnect.com. So with that, our goal today is to give an update on the latest developments related to the Paycheck Protection Program, or PPP. That has been a really hot topic for the last 2 weeks, and we've got to bring you up to speed on the latest developments. And we're also going to pivot to a couple other potential areas of COVID-19 relief, which includes the Economic Injury Disaster Loan Program, or the EIDL, and the Main Street lending programs. And then, because we have had a lot of people that have started to get their funding in, it's time for us to pivot and also do a deeper dive into how the forgiveness is going to work with respect to the PPP loans, which we're getting a ton of questions related to that now that people are entering into that 8-week time frame. So just to bring you up to speed on what we've been seeing with the PPP before we dive in, as a frame of reference, we have seen a lot of banks starting to accept applications. That process started 13 days ago, and unbelievably, as of this morning, it's been announced that the initial allocation of the $349 billion has already been committed. But we don't want anyone to panic about that. We've got some good discussions and thoughts and strategies around the status of the program, and we'll touch on that today. And also, we wanted to just celebrate for a fact that to date, of the CLA community that we work with, we have helped over $150 million of funding happen, and we expect that that number will grow as we finish off this allocation to over $200 million, which is really awesome. And we're excited to see what you guys can do to deploy that capital and help your business. So with that, I want to bring back two leaders who you guys are probably pretty familiar with now from our COVID economic relief team at CLA. We've got Todd Sprang from our financial institutions group. He has great insights on the lending side of things. And then Jack Rubicki from our real estate group, who talks a lot about the borrowing side of things. So welcome back, guys.
Thanks, Leslie.
Nice seeing you.
So what we want to do today is really start with the fact that today, especially, there has been a lot of reports that the money for the PPP has been exhausted. And we'll start with you, Todd, just on what your initial thoughts have been with respect to the program over the last 13 days.
Sure. It's amazing. The program's only been in effect for 13 days. The act was just signed about 20 days ago. And so to look back at the time we've been doing these programs, in 20 days, we've expanded the lender program, the lender abilities under this program, and the number of lenders. We've developed or enhanced or expanded the infrastructure, the systems to execute on those programs. And then almost $350 billion has been at least allocated and will soon be completed in its disbursement. And when you consider, again, that's over 15 times the prior program, and that all got done in 20 days.
It's amazing.
That's pretty amazing. But not without some difficulties, right, or some frustrations. So a couple frustrations I know that have been out there with the program. I thought they'd be at the beginning. They were also at the end. I mean, you had applicant and lender frustrations with the ramp up of the system at the beginning, and then at the end, boy, you got to like yesterday and today, the days leading up to the deadline, And from a borrower perspective, you had anxiety about getting into the program or being able to get into the program. And at the same time, you had lender anxiety because those systems that were stressed at the beginning were stressed at the end also. So lenders experienced delays, I know, from an hour on the minimum side up, and that's frustrated them in trying to deal with their borrowers who are also experiencing some anxiety. And then you have the continuous flow of information as the program progressed over those days, right? And I'll say in the short term, you know, we were getting guidance on payroll costs and loan sizing, and that was still evolving right up until the applicants that could start on Friday of last week. And that guidance was still coming out this week for them as they were applying, right?
I think everybody's been running as fast as they can, right? And it's just been this constant evolution.
Exactly right. And then you've got the fact that now you're right, we're at the end of the funding for this, but we know there's light at the end of the tunnel and that there's so many parties that are interested in refunding this program, but it just may take a while.
Yeah, and Todd, I think that's a good point that, you know, I think that this is going to represent a pause, obviously, by the SBA since they have exhausted the allocated funds. But, you know, we are hearing that, you know, Congress is on board with this, the president is on board with this, and that there will be an additional allocation. It really does just, you know, depend on when that's going to happen. And so hopefully it won't be a long pause. But I think it is important for everybody to just take a breath, you know, not overly panic here, but make sure you stay the course. And so if you've started an application, you don't want to stop that process right now. It is going to be very important to be in the queue. You know, for instance, I think the president's asked for another $250 billion of funding. On Monday, we heard that $247 billion had been approved. So that means on Tuesday and Wednesday, an additional $100 billion got approved for funding. So that 250 might not last long. And so it's important that you have your application in play and you're ready to go when that help happens again. But there are a couple good things too. I mean, as you mentioned, this is just a pause, and we have heard that some of the new legislation that's coming out might actually be beneficial for people that didn't get to take advantage of the first round. For instance, one of those things is that the multiplier on your payroll cost might move from 2.5 times to 3 times, right? And so that would say that you'll be able to get a bigger loan based on your payroll size, you know, in the next round if it comes to pass that way. So I think that you know, that's a very positive thing. I did want to touch on, though, that the shortages of funds aren't only affecting the PPP. You know, so 2 days ago, we heard from the EIDL on the EIDL program that the SBA stopped taking applications there. And there were some reports that the SBA had received almost 4 million applications, which
Wow.
represented roughly loan value of $375 billion. Now you put that in contrast to the $10 billion that they were allocated in the CARES Act, and you can see there was a little bit of a spread there. And so we know that there's a lot of frustration right now with the EIDL program. Nobody has been getting their emergency grants. They've actually changed the formula, so it's no longer just 10,000. It's 1,000 per employee up to 10,000. And we're even hearing that when they do start to approve loans, those will be rationed with the initial funding on those, maybe as low as $10,000 or $15,000. Again, just based on the fact that they don't have a lot of dollars available. So tough times for all in that realm right now.
Well, I appreciate you guys giving those updates. I think it's important to understand where we're at, and I'm glad you indicate remain calm, because we are seeing some positive things happening there with some changes in the legislation. Maybe you're even pushing back that 8-week forgiveness period a little bit, which might help your business too. But, you know, there are still people that are saying, you know, I hear you, and I need capital now. So with those two programs seeming to basically be, you know, kind of pausing or nearing the end, where else can small businesses start to turn to look for capital? And maybe, Todd, you might have some ideas on that.
Sure. I think the additional program that people turn their attention to now is that recently announced Main Street programs. And there's really two programs there. Primarily, I'm going to cover the new loan facility, but there's an existing loan facility too. The difference being that existing loan facility takes existing debt and you can add an upsized tranche to it, which falls under this program. But I'm going to stick with the new loan facility because I think if you are looking at PPP and thinking about this as an opportunity, you'd be looking at primarily the new loan facility. So let me give you a little background on that. First of all, a little patience. It just came out. I wouldn't expect it to get up and running for a few more weeks, say like 2.5 weeks. Then you'll see an application process beginning and systems starting to get, there's going to be a little infrastructure delay there, okay, as things get worked out. But let me start out with who lends under this program, right? This program is going to be insured depository institutions, bank holding companies, savings and loan holding companies. So it'll start out with a really broad group, not as broad as some of the other lenders that were in PPP than the non-bank lenders, but it will be broad. Second, then who's eligible under this program? And the eligibility requirements, there's 4 eligibility requirements. First, have 10,000 employees or less. Also, have up to $2.5 billion in annual revenue in 2019. That's one of the qualifications. Second is have a business that's organized in the U.S. with significant operations in the U.S. and the majority of its employees in the U.S. And then there's 2 other criteria that maybe apply to less entities. One is that you can't participate in both of those Main Street programs, just one. So you're either in the new loan program or the expanded loan program. And then secondly, if you have been participating or are participating in the primary market corporate credit facility, then that would cause you to be ineligible for this. So with that, let me cover just a couple of the key terms, and then I'm going to go to maybe the application underwriting process too, just a little bit to give you an idea of what we see. So key terms are, it has a 4-year maturity. It has a rate that's adjustable. That adjustable rate is going to be based on the secured overnight financing rate, or SOFR. So to a little perspective on that, that SOFR rate as of yesterday was just 3 basis points. Okay, or 0.3%, 0.03%. So when you're looking at an adjustable rate loan under this program, it's going to add 250 to 400 basis points to that base rate. So it's basically about the base rate in today's dollars. And to give you a little perspective on what that rate looks like, the 90-day average on that rate was about 1%, and the 180-day average on that rate is about 1.3%. So it's an adjustable rate, not fixed like PPP. Payments are deferred for 1 year, but interest is going to accrue during that period. So that's a good thing. You won't have the cash flow, but the interest will accrue. There aren't forgiveness features like there are in PP, but you can prepay. So that's another good feature. And also, unlike PPP, the borrower pays the 1% fee for the loan, unlike PPP where the SBA paid that loan fee to the lender for you. And then a little insight into underwriting and application. This is going to be a facility that stays on, this loan is going to stay on the books. 5% of it will stay on the books of the lender. 95% will get shifted to a special purpose vehicle. All right. So there are attestations, borrower and lender attestations with this program that will facilitate, I'll say, a streamlined underwriting process. But because the credit's going to stay on the institution's books and stay there for a little while, you can expect a little bit different underwriting process. And the lenders are still working that out. Since there's no forgiveness or SBA guarantee also, it's a little bit different from a credit risk perspective, all right? And then I'll say a couple of the things with this program are the attestations, again, will be about the fact of you're not going to use the proceeds to pay existing debt. The need for this is COVID related. And another one is reasonable efforts to maintain payroll. So there are more, but those are the basics. And then lastly, what's the amount you're eligible for? The minimum amount of the loan is $1 million. And the maximum is going to be the lesser of $25 million, or when you take your existing debt or committed but undrawn debt and add to it 4 times EBITDA, it can't exceed that. It can't exceed that amount. So you've got a maximum threshold. Also, some borrower calculation that's going to get into the mix. So the lenders are going to have to. You're going to see some work back and forth. It's not going to be as complex as the payroll costs, but there is a calculation associated with it.
That was an awesome overview. Thank you for that. And a lot. I think people should definitely contact their advisor if they have questions about that or want to explore how that might work, holistically. Jack, when you hear that and then you think about all the different things you've been seeing on the borrower side with the PPP and the EIDL, what other strategies can people be thinking about outside of Main Street lending?
Yeah, so there are a number of state and local programs that maybe haven't been getting quite as much attention just because the dollar amounts involved were a little smaller, maybe $25,000 or $50,000. Those are things that might help bridge the gap, obviously, between where you are today and the PPP or EIDL programs coming back online. There's also a lot of the tax credits or tax deferrals that if you did the PPP, you would not have been eligible. Make sure you're taking advantage of those, right? Mm-hmm. And then the CARES Act did introduce a number of tax savings ideas, which you can carry back and apply for a quick refund from the IRS. So again, getting those things done quickly and submitting them can allow you to get some cash flow in the near term to help bridge the gap until some of these programs come back online.
I think that's right. I mean, there is so much interplay between the tax policy of the CARES Act with the lending policy. And again, we talked about that a couple weeks ago, but understanding how to make both of those work for you is really critical. Jen Rowan and Chastity Wilson are going to be tackling that here in an upcoming live stream. But your point about the payroll deferral is great because people thought originally if they were going to do the PPP, they can't do that. And once they get the PPP, that's true. But the IRS did even release more guidance this week that said, during that waiting period, they can do that. So that's another area where it's great to contact your advisor, I think, and work through all of the options available to you. So with that, I know a ton of people are on the chat talking about forgiveness. People are getting their loans. They want to make sure that they follow these forgiveness formulas to a T. And kind of like we talked about earlier, we're all running fast. We don't have all of it yet. But let's talk about what we do know so far. And I want to start with a question that we're getting from the chat before we dive into all of the different factors of the forgiveness. And this one's from Tanya. She's asking if they're granted the PPP loan, when does that 8-week period of forgiveness start? So do you select it? Is it when the loan's funded? What are the rules with that? Because that'll help drive the rest of our discussion.
Yeah. So the CARES Act states that the 8-week period starts at loan origination. And I think Todd would agree that origination usually occurs upon funding, right? So while there are a number of organizations out there that have advocated for being able to choose your 8-week period as opposed to having it start then, right now under the law, it does start and it is the 8-week period effectively following the receipt of funds from the bank.
Excellent. So now that we've talked a little bit about the time frame, let's now dive into some of the specifics of the forgiveness. Again, I know that we're waiting for guidance, but maybe, Jack, you could at least provide an overview of what are the different components that people need to think about as they work through the forgiveness calculation.
Sure. And we'll do a little bit deeper dive into each one of these, but just to set the stage again for everybody, there's really 4 components that you're going to need to be concerned about. The first one is the allowable uses, and did you incur enough money on or expenses in those allowable uses during that 8-week period to qualify for the maximum amount of loan forgiveness? And then you have to look at what you use the money on that's part of those allowable uses. So there's some new guidance that came out in the interim final rule that introduced a new provision that said 75% of the loan proceeds need to be used for payroll, at least 75%. And then the inverse of that no more than 25% can be used for non-payroll related items. So, those really kind of deal with the expenditures of the funds and then how you spent them. Then there's 2 additional tests, one that deals with employee retention, and then the second of the financial type or operational type tests deals with, are you paying people a comparable wage? So those are really the 4 components of forgiveness. And whenever you fall short on any one of those result in a decrease in the amount of the loan that'll be forgiven.
So that's a great overview. And I think in theory, when it was drafted, sounded simple. As we know, the devil is always in the details. And, we never even can contemplate all the scenarios that come up until people start asking questions, which is why we appreciate everyone's questions. So with that, why don't we start to unpack some of these a little bit further and talk about some of the things we're seeing. One of them is allowable uses. So you shared in the past that's payroll costs, it's rent, it's utilities, it's mortgage. But we've gotten a ton of questions on this. And so, what are some other things borrowers should know about allowable uses as they start to work through their calculations?
Yeah. So the payroll cost piece is a very comprehensive payroll cost, right? So it's your baseline wages and salaries and commissions and tips and things of that nature. Those are limited to $100,000 though, right? So you may pay people more than that, but when you look at your allowable uses, you're only going to count up to the annualized equivalent of $100,000. Also included in payroll costs are things like group health benefits, retirement plan benefits, and the employer portion of the state and other payroll taxes, but not the employer federal payroll taxes. So it is a fairly, broad-based compensation number that is included in there. One of the things to note, though, is that when you look at the employee piece of it, the allowable costs really get measured on the individual employee basis. And so it's not a holistic test where you just look at payroll versus payroll. That $100,000 limit is applied at the individual employee level. So it is important that you're going to have to maintain detailed payroll records and supply those to support the amounts. The big question that we're hearing right now, though, is, what period is it really, and what does incurred and paid mean, right?
Yeah, we're seeing that all over the chat today.
Yeah, is it cash basis? Is it accrual basis? What if I incur 2 weeks of payroll and then I get funded and then I pay it the next day because they weren't incurred during the period? Is that going to count? I mean, there's so many questions out there, and quite frankly, we don't have answers on those types of things that are the nuances. And so we have heard that if you're cash basis, it'll largely be cash basis. If you're accrual, it'll largely be accrual, but you'll have to have a certain window of time where you actually fund those accruals on the back end. And so we expect a lot of guidance out on that one because there are a number of unanswered questions there.
And I think to the extent they're uncertain right now, they've got to make those expenditures and start to track things the best they can right now, and then just keep watching for guidance.
Yeah, for sure. And, there is guidance out there a little bit about utilities already, kind of what constitutes utilities. So, cable TV or entertainment type things don't constitute a utility. Right. But, things like internet and others, do. Group health benefits, too. There's some guidance out there in the Internal Revenue Code that you can look at. So what constitutes group health benefits? But things like key man life insurance or executive plans clearly wouldn't be part of that, for instance.
Yeah. So again, keep asking questions, talking to your advisor, and they'll keep clarifying things as things roll out.
Yep.
Well, Todd, why don't we ask you a little bit about this 75% and 25% concept that Jack threw out? We've gotten a lot of questions about that, a lot of fear too with what it means, like about this forgiveness being all or nothing. So I think you can shed some light on it and provide a little bit of a sense of calm as well.
Yeah, I can say, as Jack has said, we would hope for some additional guidance. I would hope for some sort of vehicle also to reconsider, because I think when, from both a lender and a borrower perspective, at the time these guidelines were set up, the health issues that related to people, being restricted, right, were expected that there was a duration associated with it, and that's what this program was supposed to line up with. So now you take that, if that duration is expanded to where people can't go out, and let's just say restaurants, it's something we commonly hear about, right? If people aren't able to go to restaurants, or at least when they're able to go, if they're only able to staff to say 50% capacity or customers to 50% capacity, then it's a struggle for that borrower to meet those payroll costs, have 75% of the forgiveness attributable to payroll costs, right? And there's so many other businesses that are very much like that. Without people returning to, say, their normal lifestyle, it might be really hard to make that threshold while having people be productive, right? You can put them on the payroll, but there may not be anything for them to do. And so people are struggling with that concept. And I'd hope that maybe in this process we could come up with some, I'll say, reconsideration based on what we know is a longer timeline for life returning to normal.
Great. Well, Jack, let's dive into lastly here the employee retention test, because I think in theory it sounds pretty straightforward, at least when we look at the CARES Act. But, you know, I think there can be some pitfalls when we run through that calculation if we're not careful.
Yeah, it should be straightforward. A couple things to note on it. Generally speaking, it's not an employee headcount test like you had to do for eligibility, so it does differ there. It is an FTE test, right? And so FTEs are going to be measured based on a traditional measurement technique. We think there's going to be 3 buckets with salaried, full-time, and part-time, with salaried and full-time counting as 1 FTE, and then part-time measured using a 30-hour work week. We don't know that for sure yet. Hopefully we'll get some specific guidance on that, but that generally is the way the SBA has managed that in the past. In terms of the calculation itself, you're going to look at the FTEs that you have during the 8-week period, and you're going to compare that to one of 2, I'll call it pre-COVID periods, right? So either a comparable period for 2019, so a February through June period for 2019, or a 2-month period in January and February of 2020. And so those are your 2 kind of baseline periods that you can choose. And then as a borrower, you get to choose the one that's more beneficial. So whichever one of those 2 is lower, that becomes your denominator. Obviously, your FTEs are your current 8-week period FTEs are your numerator. And so the extent that that's a ratio and it's less than 1, that kind of dictates your forgiveness or the piece that's not forgiven. The one thing I do want to point out, though, there is a potential for a rehire to positively impact that. So if you had terminated folks and then they're not in your FTE count, but you hire them back on before June 30th, those they get pro forma'd into your FTE count for the 8-week period. So as long as you do bring them back before that June 30th time frame, you'll be in good shape and you won't lose any money as a result of this particular test from a forgiveness perspective. However, as Todd mentioned, you still have to hit that 75% of payroll test. So if you defer the hiring just to save a few dollars, you may not meet the 75% payroll test. And so that's kind of the counterbalance to hiring back late rather than early. So if you want to maximize the forgiveness component related to this and the 75% test, generally we're recommending that you try to bring your people back as close to origination as possible. But again, a lot of planning that goes into that.
Great. Well, I want to end with one more question that we got from the chat. So we had somebody say that they lost a huge client and they have to drop their employee count drastically. We're actually hearing that from a lot of people. So how does the forgiveness work when they're not going to be able to bring those employees back?
Yeah. So, I mean, unfortunately, what you'll see is that you're going to miss the 75% of payroll test, and you're going to have an FTE piece that you're going to have a low retention percentage. As a result of those 2, you may only end up with, let's say, 40 or 50% of your loan being forgiven as opposed to 100% of your loan being forgiven. We think that that's the mechanism right now where basically the unforgiven portion converts into a 2-year term, 1% interest rate loan, right?
Still cheap capital.
Yeah, so it's very cheap borrowing capacity. It is a 2-year period, so you might want to see something longer than that, but it does give you some runway. The concern is that if you use a real small amount on payroll, like if you went into it knowing you weren't going to bring back those people, there could be an interpretation at some point in time that says you've got to refund those dollars sooner rather than later. So what we would recommend is if you're in that situation, Keep those dollars in the bank. Try not to spend them until you know how the SBA is going to interpret this. Once we get a little bit deeper into the forgiveness period and they start to issue some guidance there, that way, if you do have to return those dollars at some point, you're not having to scramble to find them.
Well, this was really insightful, and so I want to thank both of you so much for guiding us through this. And it's really clear that we need more guidance from Treasury on the forgiveness topic. I want to say thank you to all of our live stream viewers for asking questions, being part of the dialogue with us, and just encourage you to remain calm right now amidst all this chaos. If you haven't been able to secure funding yet under the PPP or the EIDL, we still think there's a high likelihood that that opportunity is going to come. So we just encourage you to understand your cash flow and your working capital needs right now and talk to your advisors to be able to work through that. We hope today gave you a nice overview of the forgiveness calculations. We know there's a lot of complicated pieces to that, and we've got tools that can help you model both the forgiveness and cash flow with CLA Intuition. So we encourage you to reach out. Thank you for all your questions. Thank you to all of our individuals in the chat for engaging and helping with that. Please stay safe and healthy and have a wonderful afternoon. Thank you.